This is the OANDA podcast, brought to you by Jazz FM's Business Breakfast.
You're listening to the OANDA Market Insights podcast, brought to you with Jazz FM Business Breakfast. I'm Jonny Hart. Each week I preview the market and business headlines with Craig Erlam, Senior Market Analyst at OANDA. And it's a very good afternoon to Craig. How are you doing?
I'm really good, mate. How are you?
I'm pretty good. Let's start with your overview of markets at the moment. Where do we stand globally and as far as the UK is concerned?
We're doing quite well, to be honest. I mean, sentiment is such an important thing right now. I find we went through that sell-off towards the back end of last year, and it was a real big test for investors. A lot more talk about recession, things we haven't become used to that much in the last few years. We're on a very good bull run. So there was a big test in Q4 last year, so it's really important to see how we were going to bounce back in the first quarter. I think we've bounced back really, really well. You look at, for example, US indices, and we're about 5% off the highs that we were at the start of Q4 last year. Considering we fell about 20%, that's a nice, solid bounce back. It suggests that this is hopefully more than just a little bit of a corrective move, so that's quite positive. We are seeing positive developments materialise, which we'll touch partially on throughout this podcast, things like trade, things like central banks becoming less hawkish. I think that's quite encouraging, that's quite supportive as well. And even when you look at things like oil markets, right, this positive risk appetite has spurred them off the lows, and I know that's not ideal for the consumer, but really there is always a level of oil where it's both positive for the producers but also positive for the consumers, and we're kind of moving back towards those levels. So overall, I think markets are relatively healthy right now. I think there's maybe some anxious times ahead, and I do think there's plenty of risk factors still around, but I think we're in a much healthier position than we were even a few weeks ago.
You mentioned central banks, and we've got some interesting minutes, well, interesting-ish minutes coming up. I think
use that term lightly.
Yeah, probably the Fed minute's a bit more interesting than the ECB, but both sets are likely to be much more dovish than in previous months.
And I think that's the important thing here. No one's sitting down with a fine comb going through these minutes. At least most people aren't, right? We're looking for what are the key themes in it, and they're probably going to confirm what we saw in the press conferences, etc., that followed, and the statements that followed the actual meetings themselves. Taking the US one as a prime example, it was noticeably more dovish from the statement and from the chair, Jay Powell. And I think that's going to be a common theme across major central banks, at least for the first half of this year. And slowly but surely they are revising down their both economic forecast but also their rate hike forecast as well. And that's brought some calm back to the market, and I expect the minutes to really reiterate that.
Now, with Brexit Groundhog Day continuing, Craig, some missed the spectre of Germany narrowly avoiding recession. I was thinking, with that a possibility going forward, surely that's going to put a bit more pressure on Angela Merkel, the Italians, the French, to sort out a deal with the UK, because that surely would tip the German and the EU economy into recession if there isn't a deal.
It is borderline right now where we are standing with these economies, and I think there's numerous headwinds this year. The slowdown in China has really negatively impacted the European economy. There is more temporary factors as well, which we've touched on before. Things like the car manufacturing production has really hit Germany and Italy as well. That's to do with the emission testing, which has caused backlogs. So that's having an economic impact. But I do think they are going to be looking at these Brexit talks, saying this is a major risk and it's coming at possibly the worst time. So yeah, there is pressure from both sides politically to get a deal.
Good for the UK, perhaps?
It could be viewed as good for the UK, and we can never underestimate the impact of politics on decision making, even if it's not always in the best interests of the longer term prospects. You always think with these things, Merkel et al. Are going to look at the European project and always prioritise that first, and I think they always will. But domestic politics will always play a role. We just have to look at that BBC programme on the European Union, that 3-part special, and it really, I've watched the first 2 episodes now, and it is fascinating to see. They really are so committed to this project, but ultimately they can only positively impacted as long as they retain their standing at home. So you see a lot of domestic politics having highly influencing European policy making. So yes, there is going to be a domestic factor playing a role here, but I think there's a desire, even without this on both sides, to get this over the line and move on, because Europe has its own problems, as we've seen over the last 12 months.
You mentioned China earlier on, and those trade talks between the US and the Chinese continued. Of course, they broke up without a deal in China. They now moved back to the United States. I don't quite understand this to and fro between the United States and China. Why can't they just have it in one place? And they need to secure a new deal before further US tariffs are imposed on the 1st of March. Are they going to get that deal?
Yeah, it's very polite, isn't it? This idea of we'll spend a week at yours and then you can come round to mine for a week and then we'll go back to yours. It's probably costing them a fortune. And
I shouldn't think they're paying.
No, hopefully they're picking up the air miles there. It's positive. I think that's the most important thing. Quite often with these talks, you can have a few days having negotiations, then you go away for a month, you come back. It does feel like we're kind of in hyperdrive here. 5 days of talks back to the US, 5 days of talks back to China. And I think this is really positive. It shows how much desire there is on both sides to get this deal over the line. I don't think that's going to come by the end of this month, and Trump this week suggested that there could be an extension, that the can could be slightly kicked down the road. He suggested a potential 60-day extension. I believe the Chinese wanted 90 days, but he's insisted on 60. Clearly, again, very desperate to get a deal over the line, really cut down the negotiating time. So I think there is a lot to feel optimistic about, because this is effectively 60 days without any new tariffs, which is positive for the markets. It's been a major headwind for the markets, this trade scuffle, as you could probably suggest it is. And I think we are working towards a solution that is going to arrive. We're just going to have to wait a little bit of time for it.
We're also going to get the latest UK jobs data. Interesting that we saw last week wages now rising a lot faster than inflation, which of course dropped below 2%. What are markets expecting with this new jobs data?
Yeah, wages are expected to continue to pick up, so around 3.5% earnings growth, and unemployment's remain at 4%. It's amazing to think that the economy's actually, when you look at the labour market, is doing so well at a time when we're not just looking at domestic issues. I mean, you look at, for example, you said the GDP data last week, we saw business investment down, I think 4.7%. We saw consumer spending was down. We saw the economy actually contracted by 0.4% in December. We saw the economy didn't perform too well in the entire third quarter. And the worst year of growth, I think, was it since 2012. Like, the economy looks like it's really stalling, but you look at the labour market and it's thriving. And we've seen this interesting scenario in the US as well at times.
It's a historical anomaly, really, isn't it? I don't think I can recall any time in economic history where this has happened. Under normal circumstances, this would have been a primary case for an interest rate rise.
Yeah, I think you're kind of seeing a couple of things play out here. I think the evolution of the labour market in many ways is having a role in this. We talk about the gig economy, the flexibility of the labour market. Well, it's one of these things that, yes, we're seeing economic difficulties now, and we are seeing a lower investment. And at the moment, that's okay for jobs. We're not necessarily seeing these people let go. Or what that would suggest to me, if this is what this is a structural change in the labour market, is that if we do tip into recession, that unemployment figure will rise and rapidly, because it's easy to lay these people off because of the flexibility that exists, which is helping it for now. But when you do hit rough times, then it's that much easier. But I think these numbers are generally positive, because what they suggest to me, and I think this is the most important thing, is when you're going through a difficult time like this and you've got a flexible labour market that allows you to go through this time without causing too much carnage and essentially exacerbating the issue. Because if you can imagine unemployment now rising to 4.55% in response to these near-term headwinds, then all of a sudden you start this negative loop where negativity begets negativity, and economic slowdown turns into a recession. And if we can this flexibility allows us to go through this minor storm, and we get this Brexit deal in March, and we move into the transition and we avoid this, and then we maybe get that economic stimulus from the backlog of investment and consumer spending, then all of a sudden this situation, which could have got much worse, actually hasn't been too bad at all. So I think the labour market figures there are really telling and actually really interesting as well.
Finally, any earnings we should look out for?
There are a number of earnings. It's more European over this next week. For example, we saw RBS earnings today, which were very good, especially when you're looking at how they performed over the years back to profitability. But there's a lot more European earnings now over the course of this week. Less focus on the US, and it's going to be really interesting to see just how this European earnings season really pans out, because, like I say, the US is still performing very well by European standards. They're not thriving like they were last year, and those Q4 earnings did start to see a slowdown. But Europe, as we're talking about now, we're talking about economies in recession or at threat recession, so we're going to see things from a very different perspective.
Craig Erlam, thanks very much for joining us.
Thank you.
That was the OANDA podcast from the team behind Jazz FM's Business Breakfast, a daily early morning 30-minute briefing for the day ahead. On air from 6 a.m. Listen to Jazz FM on DAB, online, or just ask Alexa.